Mutual funds and ETFs look almost identical from the outside. Same kind of basket, same kind of returns. But 5 structural differences decide whether you keep an extra $20,000 over 30 years or hand it to the IRS for nothing. Right now in the United States, there's about $26 trillion sitting in mutual funds. There's another $10 trillion in ETFs. Mutual funds are still bigger by a wide margin. But here's the twist. ETFs have been growing by about $1 trillion a year, while mutual funds have actually been losing money. Investors are pulling cash out faster than they're putting it in. This video is about why. Let's start with what each one actually is. A mutual fund is a pool of money from thousands of investors. The fund company uses that pool to buy a basket of stocks, bonds, or both, and you own a share of the basket. Most mutual funds trade once a day, at the closing price calculated by the fund company. They often require a minimum to get started, typically $1,000 to $3,000, and they come in 2 flavors: passive funds that track an index like the S&P 500, and active funds where a manager tries to pick winners. An ETF, short for exchange-traded fund, holds a similar basket of stocks or bonds. The key difference is right there in the name. ETFs trade on a stock exchange, just like an individual stock. You can buy and sell them at any moment during market hours, at whatever price they're trading at. There's no real minimum to get in. You just need enough money to buy 1 share. Most ETFs are passive index trackers. Active ETFs exist, but they're a much smaller slice. 5 differences when you put them side by side. 1. Trading. Mutual funds price once a day at market close. ETFs trade all day long. If markets are crashing at noon and you want out, only the ETF lets you sell right then. 2. Minimum investment. Mutual funds typically require $1,000 to $3,000 to start. ETFs require the price of 1 share, often $50, sometimes less. 3. Fees. The average mutual fund charges about 0.5% per year. The average ETF charges about 0.0001%. On $100,000 over 30 years, that gap costs you over $50,000. 4. Tax efficiency. This is the big one. Mutual funds have to distribute capital gains to shareholders every year. ETFs almost never do. They have a creation and redemption mechanism that defers taxes until you sell. And 5. Best account type. Mutual funds shine inside a 401k or IRA, where taxes don't apply. ETFs shine in a taxable brokerage account, where every dollar of tax saved compounds. Let's quantify that tax difference. $10,000 in a typical mutual fund, paying out capital gains every year and dragging your effective return down by about 1%, grows to roughly $76,000 after 30 years. $10,000 in an equivalent ETF, almost no annual tax distributions, grows to about $100,000 over the same period. Same investment, same market return. $24,000 more, purely from how the funds are taxed. But mutual funds aren't dead. 4 scenarios where they still win. 1. Inside a 401k or IRA. Tax drag doesn't apply in retirement accounts, so ETFs lose their biggest edge. 2. Target date funds. The most popular all-in-one retirement fund structure exists almost entirely as mutual funds, not ETFs. 3. Automatic dollar amount investing. With mutual funds, you can invest exactly $200 every month with no fractional share workaround needed. And 4. Niche actively managed strategies. A small number of active mutual funds genuinely beat their benchmarks, though they're rare and getting rarer. 3 myths to bust before you go. Myth 1. Mutual funds outperform ETFs because they're actively managed. False. Over any 20-year window, more than 90% of actively managed mutual funds underperform their benchmark. That's per S&P's SPIVA report. Active management doesn't beat the market on average. Myth 2. ETFs are riskier because they trade all day. Also false. The underlying holdings are identical to a comparable mutual fund. Being able to sell at noon doesn't change what you actually own. And myth 3. Mutual funds are for retirement, ETFs are for taxable. Outdated. Both work in any account. The real choice depends on the structural differences we just covered, not the account label alone. Mutual funds versus ETFs comes down to 5 things: trading flexibility, fees, minimums, taxes, and how they fit your accounts. For most investors building wealth in a taxable account, ETFs win on cost and tax efficiency. For 401ks and IRAs, mutual funds still hold their ground. Pick the structure that matches the account, then stick with it.